Dividends are great, right? I mean, historically, the S&P 500 has returned about 10% annually over the long term, and about 31% of that return has come from dividends. While researching market stats for my last video, I found that the dividend yield of the S&P 500 is near historic lows, around 1.2%, which is about 70% below its long-term average. As one of the main ways companies return capitals to their investors, dividends are falling out of favor, especially when compared to buybacks. So, are dividends slowly going extinct? Before we dive into this question, let's first explore what dividends should look like. In a perfect world, dividends would be paid out with the cash left over from operations minus items like paying down debt, making investments, and increasing cash reserves for a rainy day. That means dividends should naturally vary year over year as business conditions are ever changing. But in reality, that is not how it works. Companies try very hard to maintain and increase their dividends year to year. Why? Because dividends create the psychological perception of financial strength. And that's why some companies pay out nearly all their earnings and then some just to maintain the image of stability. Even worse, a few companies continue paying dividends despite having losses. This perception of financial strength is reinforced by the famous dividend aristocrats and dividends kings list of companies. These are companies that have raised their dividends for 25 and 50 years consecutively. For simplicity, let's call them the dividend royals. These royals have certainly earned their reputation for being financially sound companies, but it comes with a lot of pressure because if management even hints at altering the dividend, investors may lose confidence regardless of the actual fundamentals of the business. And even if these companies were able to pay and increase their dividends over the years, history shows many moments when cutting the dividend or pausing the dividend would have made perfect sense. Take the pandemic, for example. Many dividend royals would have been better off pausing or reducing payouts to focus on making investments and navigating the unprecedented business landscape caused by the pandemic. But instead, they focus their limited resources, both financial and human, to keep raising dividends just to protect their image during this time. On the flip side, growth companies often face the opposite problem. Once they start paying dividends, investors assume their growth days are over, again, ignoring the fundamentals. Because they assume the company is paying dividends as they are unable to find growth opportunities with the cash. In short, the psychology around dividends often drives irrational decisions for both management and investors. Dividend yields are another area that cause investors to make irrational decisions as many dividend investors see a high yield and chase those stocks, not realizing those yields may not be the opportunities they think they are. Two common examples are companies in trouble and REITs, or real estate investment trusts. When a stock falls for fundamental reasons and management refuses to cut the dividend, the yield can appear large. And that's when many dividend investors start seeing dollar signs, unaware that the high yield is a warning sign and not free money. And once the reality of declining fundamentals set in, the company eventually cuts or cancels the dividend entirely, leaving yield chasing investors holding the bag. With REITs, they generally have higher yields compared to traditional companies due to the 90% payout rule, which means they are required to pay out 90% of their taxable income to maintain their status as REITs. The catch? Generally, dividends from REITs are non qualified, meaning they are taxed as ordinary income up to 37%, excluding state and local taxes. By contrast, qualified dividends are taxed up to 20%, again, excluding state and local taxes. So, while REITs might look like they pay more, a big chunk of that yield gets eaten up by taxes. And on the topic of taxes, dividends are also less tax efficient compared to buybacks. Because every year you receive a dividend, you owe taxes, even if you reinvest it. But With buybacks, there are no taxes until the shares are sold. So, let's break down how taxes on dividends affect the long-term rates of return on the S&P 500. As mentioned earlier, historically, about 31% of the S&P 500's total return comes from dividends. And with a 10% long-term rate of return on the S&P 500, that's about 3.1% from dividends and 6.9% from price appreciation. Assuming a 20% tax rate, that 3.1% shrinks to 2.48% after taxes, bringing the total return down to 9.38% per year. That 0.62% difference might sound small, but over a 30-year savings period, it compounds into a massive gap of about 18%. But now, let's imagine a company that had used buybacks instead of dividends. Your ownership stake would have quietly increased over time as other shareholders sold back their shares, and you wouldn't have a tax bill until those shares were sold. Berkshire Hathaway is a perfect example of this, as Warren Buffett has preferred buybacks over dividends and avoided stock splits. Its Class A shares are worth nearly $750,000. So, with all that said, are dividends dying? There are certainly arguments for dividends, like providing steady cash flows, which reduces the investor urge to time the market, and using tax sheltered accounts like IRAs to lessen the tax burden of dividends. But the trend is clear, as dividends have been losing ground to buybacks as a method of capital return from 2010 to 2024, and 2025 looks to continue the trend. While dividends won't disappear entirely, they are becoming less central to modern portfolios as buybacks continue to grow in popularity primarily due to their flexibility and lower commitments.